Very interesting, but double the amount of information for you, which is the best thing for you as a listener and a viewer. Today we have Liam Brooke. He is the co-founder of Lendy, which also used to be known as Saving Stream. Some of you know it as Saving Stream, is now rebranded again as Lendy. And we have Paul, hopefully I will not butcher your name, Riddell,
that's correct.
Riddell,
yeah.
Paul Riddell.
Riddell was in Greece, but...
Okay, Paul Riddell, who also works Lendy in the communications department. And we've got them here today to let you know all about what the company's doing. I'm going to ask them some questions about things that are going on that I personally would like to know about. And I think a lot of your questions also about the platforms, the way it works, and some of the upcoming changes that they've just announced too in the last couple of days. So for all of you who are listening who do not know what Lendy is, I'm going to ask Liam, the co-founder, to give you a quick synopsis, about a minute, explaining what Lendy does, and if you're interested in investing your money, what exactly that would entail. So go ahead, Liam, and explain to everybody, what is Lendy? What do you guys do?
Well, hi, Lawrence. It's a pleasure to be here. Thanks for inviting us.
Thank you.
What is Lendy? Okay, so back in 2012, we identified that there were two problems in the market. There were investors out there that wanted and needed a better return than they were getting in this low interest rate environment. And there were borrowers over here that were struggling to borrow, even if they had an incredibly profitable and sensible project, because the banks had pulled out of the market and they were too scared or didn't have the resources or the infrastructure or the knowledge or the expertise to do what they needed to do and support these property developers and investors. Effectively, there was liquidity missing from the entire market. So we decided to put the investors and the borrowers together via the Lendy platform, and we would create the opportunity for business transactions to happen. So the platform allows our investors to pool together their funds in order to finance developments and property purchases. We ensure this process is fast, simple, and secure, and delivers a gross annual return of averaged 12% per year for the last 5 years. So, over 300 million quid, we've returned over 25 million pounds to our investors in interest alone. We've grown incredibly quickly, we've doubled our loan book in the last couple of years. We've doubled our investor numbers in the last 8 months, and we're looking to grow to be the largest and most profitable and capable business P2P platform in the market. We've got over 25 staff now with over 200 years of banking experience, and we've got solicitors, we've got lawyers, we've got accountants. We keep track of all of the loans, and we make sure that your money comes back in a fast, efficient, and safe manner.
That was a good synopsis. Okay.
I suppose it was quite investor focused, wasn't it? So from the borrower side, I guess, we've got all these people, borrowers, and they want to lend you the money, but they want a good return on it, and they want to invest in safe projects. So our expertise comes at writing a loan quickly, summarizing it, checking it, and putting it into our investors nice and quickly, and getting their buy-in because they trust us, because we've been doing this for 5 years and we know what we're doing. We've done over 300 million of loans so far. The largest loan we've ever done is £8 million in one go. We've got over £11 million in one building project, but the average loan is about £1 million, £1.5 million.
Liam, we'll start with you. About what's your background? Where did you come from? Previous line of work before you started Lendy as a co-founder?
So a brief background myself. I've got from leaving university, I went to Barclays Bank and joined their corporate graduate scheme back in 2005. Small business lending, so lending money to small high street little shops and little companies. I had about 300 small retail businesses as my customer base at that point, and then slowly over the years climbed the scale and the size of the businesses which I managed up until companies of 50 million plus turnover. After a few years of that, it was into property banking. So I thought property development banking was the way to go. And 2008, the end of the world, an opportunity in the Middle East came up to go and work for Al United Bank in Bahrain, where I spent a couple of years, had my son out there, had a lovely time, and then came back to the UK in 2010 and worked for a small investment company in Switzerland, based in the UK, and in time started a business with my co-founder Tim, and we've been doing Lendy for 5 years now.
Okay. And what about you, Paul? What's your background?
Okay, hi Lawrence, nice to meet you online. Yes, I've got sort of 25 plus years in financial services, working for Canadian companies like Sun Life Financial, French companies like AXA Group, ran their marketing and communications for them, and also Swiss companies like Credit Suisse. Specialised in communications, PR very early on, and then broadened my role over the years to cover brand, marketing, customer, and you really get into the heart of businesses. What a business is about, what's the purpose of the business, to try and get that into the DNA of companies. So, 25 years plus, and my last role was as running the marketing for AXA Group, and I specialised in that in looking after the innovation program, which put me in touch with lots of fintechs in Silicon Valley and in London as well. So when the opportunity to join Lendy came up, small company growing fast, etc., was a big appeal for me.
Thanks for the background information. Now, quick question for both of you. We'll start with you, Liam. Do you personally invest in peer-to-peer lending, crowdfunding, aside of what you put into your own company? Do you do any other company investing or not?
Well, regardless of the fact that when we started the business back in 2005, we used our own capital to lend on the projects. So we started off the business lending against marine assets, which is why Lendy Cows Week has been such a great synergy for us. So we lent our initial capital against the assets and then sold them down onto the saving stream at the time, saving stream platform. Mm-hmm. So we recycled our own capital from day one. Now, over time, we've got to the stage where we've lent over 300 million now. I don't have sufficient capital to underwrite everything. So it came to a point where we did invest in our own platform. The FCA have decided that that's a negative thing, so we now don't invest in our own platform. But in terms of the industry, yes, I invest in another couple of platforms, but obviously not too much. I don't want to give them too much competition, my money.
No.
But no, we respect the industry as a whole, and obviously after doing very, very thorough, detailed due diligence, there are a couple of platforms out there that I think are capable and robust enough to look after my money in a very stringent and successful way. Yeah.
Now, would you like to go out on a limb and share which companies you believe are robust?
I wouldn't want to advise anyone.
Just an opinion. Just an opinion.
Yeah,
if you want to give an opinion. If not, you feel free. It's up to you.
You know what? The UK system is very robust and trustworthy. There are other platforms out there that I wouldn't invest in, but there are quite a few that are very thorough and very trustworthy. So I'm not going to say which one, so no chance. But the UK is probably the best place to put your money.
I'll keep prodding you for a name until you just get sick of me asking you. Like, oh, whatever. Paul, what about you, sir? Do you invest outside of Lendy, any other peer-to-peer companies or crowdfunding platforms for your own personal self?
Like Liam, I do just a little bit. I've always invested since I was a young person, and so I've always had a small percent in P2P since it's been around. Again, I can't name them. Okay. We're not allowed to invest in our own platform. I probably would if we could, but we're not allowed. But it's certainly. I certainly see it as an important part of a diversified investment portfolio to have some exposure.
Yeah, I think that's a good thing. And it's nice to hear that the people running the companies are also not just investing in their own company, but also outside in the sector. A lot of the times I just call it spy money, because sometimes they're just spying on the other platforms, which is fine too. I mean, I would do it too.
There is a degree of that in but
yeah, you have to keep up on the competition, right? I mean,
so that's how they do it.
They're doing it to you, believe me. Everyone that I've asked, I'm spying here and there. So let's talk about non-UK residents briefly. Our good friends in America are always looking to invest in the UK peer-to-peer companies. Most of the time, they're not able to. With Lendy, can the US residents invest in Lendy? Or through Lendy, I should say.
We are a global platform. There's something like 20% of our investors are overseas. We don't put any restrictions on on a country-based restriction basis, but as long as they pass our very, very thorough, rigorous AML processing and KYC, then we don't have a problem having anyone from around the world being a member of our team.
Okay.
Our investment team, I think.
So great news. As long as they can prove that they're not laundering money for Donald Trump, they're in. Okay, that's good to know. Can you explain to me a little bit about how you pick and choose the deals that you are offering to lenders on Lendy?
So the process is that we have a network of commercial finance brokers. I don't know what it's like in the US, but in the UK there are commercial finance brokers who are generally all part of the National Association of Commercial Finance Brokers. There's about 1,000 of them. So we spend a lot of our time building relationships with these brokers who then go out to the market and try to win deals from individual developers and property traders and people looking for short-term finance. We decided to go down that route because spending, one, it's easier because otherwise you've got to shoot a shotgun approach. And we decided that through the commercial finance broker network, it's more like a sniper. We can focus our time and attention on building relationships with the brokers, and then they feed us with deal flow, and we filter from those deals what the brokers provide us. Now, in terms of the filter, obviously it's a trade secret, but we can let you know that it's based on 5 fundamentals. And those fundamentals are the valuation of the asset, the basic fundamental premise of what we do is based on the valuation of the property, the open market value, what someone would pay for it. Okay. Now, there are different types of valuation, i.e., when can you expect to dispose of it? The open market value is 6 months, or a year. The 180-day valuation and the 90-day fire sale valuation. So we take all of those into consideration as part of the valuation process. Each valuer, we outsource it to a professional valuer who has independent indemnification insurance. So if they get it wrong, we have recourse.
Okay.
So that's the major thing is valuation. So as the other 4 things, we've got the credit checks on the borrower underlying. Well, we need to know what this borrower is about. Is he going to pay us back, or does he have a tendency not to, based on his history? The searches of the property, so we make sure that all the legal stuff is tied up. So if we're going to lend money to this guy, at least we've got tight security over the asset. And the final thing is the assessment by our credit committee. Now, this is the key. We've got a 49-point checklist that our credit team go through to get this thing to conclusion. Firstly, they get the deal from the broker. We discuss the financials and the economics. We then agree a deal with the customer. It comes in. We perform our basic credit due diligence, and then we start instructing legals. And now remember, these are short-term loans, so everything has to happen concurrently. Mm-hmm. Everything has to happen all at the same time.
Right.
For example, we had a deal in on the Wednesday for an £8 million loan against a £13 million property. And the guy needed the money to exercise his option. His option was running out the following Wednesday. So, why he'd left it so late, we don't know. But came in on the Wednesday. We'd managed to perform by the Monday more, if not more detailed, thorough credit checking and due diligence on this borrower and the property, had the valuation rewritten in our name, and raised £8 million from our 16,000 investors in 5 days. We managed to get this guy one of the world's biggest P2P loans within less than a week. Mm-hmm. So what we don't do during that process is skip any due diligence. We add due diligence to what a bank would do on a 3-4 month process. We can do it in a week.
Okay, that's pretty fast. Yeah. 8 million in 5 really days is pretty impressive.
Yeah, I don't know what PBL number it is, but it's still up on the website. It's JML House in Hackney.
That's right.
Hackney. Yeah.
One of our one of our themes is fast turnaround finance. So we have to kind of live up to that.
What is the average amount of time that it normally takes you to get a loan from start to drawn down process?
As we say, fast turnaround finance. We aim to do things as quick as possible. So we've got our processes in place that allow us to do that. Now, the problem with this entire market is that there are very many different third-party professionals needed to make it happen. So if a valuer has gone on holiday, if a lawyer has a baby and goes on paternity leave, or maternity leave, beg your pardon, and
paternity leave.
And one of 15 different people. If the ducks are not in a row, then the process cannot flow. I should have been a poet.
Did you make that up? That was good.
Should we write that one down? I'll keep that one. So if everything isn't aligned correctly, then things get delayed. So we've had loans that we get a lead in January and it's only just completing this week. Not because it's a bad deal, it's just because information that we were waiting for, questions that we asked as part of our credit process, if they don't get answered, or if they get lost, or if someone goes on holiday or something else, things can drag on. But actually, if our expertise is available, and the process and the systems are all available and driven towards making these loans happen super, super quick. So we're not the cheapest in the market by any stretch of the imagination. But what we are, we would consider ourselves as being one of the quickest.
Yep. Well, 5 days, 8 million is pretty quick. So that's impressive. What's the single largest investment that's been put into your platform from a lender's perspective?
So we don't want to talk about any individuals. I don't think that's fair, but we have quite a few, like in the tens, of individual investors with over £1 million with us. The average investment. Well, we've got nearly 17,000 investors now, and we've got a loan book as of today of about £180 million. So the average investment is circa £50,000 a person.
Okay. All right.
And that's made of 20% international, but 80% UK.
Okay.
And weirdly, contrastingly, talking about Brexit, we've actually seen an uptick in international investors into the UK. It must be something to do with the falling pound that makes the yield on the fixed income asset that they're investing in more appealing.
Question for either one of you. Give me a quick overview of what you think is going to happen to the UK property market in the next 12 months with the whole Brexit looming over the market. Where do you foresee it going as far as valuations and things like that?
We expect it to slow a little, and we're seeing signs in London that it's sort of slowed a little, but it's, Brexit, there's been political uncertainty in the UK with the with the government losing its majority, etc. And there's uncertainty elsewhere as well in America and stuff, and that all feeds into investor sentiment. So we do expect the property market to slow a bit, but the UK, which is different to many other countries, has a drastic housing shortage for all sorts of reasons, aging population, etc. And we know government after government after government have failed to meet their house building targets, so there is that shortage will continue. Therefore, we expect the housing market to hold up very well over the next few years. We don't expect any major crash. So we expect it to hold well, and which is why we specialise so much in property as our asset class for investors.
Okay, Liam, you got any thoughts on that?
Just to reiterate, we think the UK property market is very fundamentally out of kilter in terms of supply demand. There is too much demand and not enough supply. So for me and our business, that just makes sense to stick with it, regardless of what's happening on a macro global perspective and even on a sort of micro UK economic picture. We think the UK property market, if worst case scenario, if everything else went wrong, UK property market would be the last to suffer. So we're happy where we are.
Okay. Let's talk about the secondary market, which has always been a major positive on Lendy. People have seen it as a way to be able to liquidate loans very easily. Things kind of change when you switch the requirement of having to have funds in the account to be able to buy loans, and the liquidity has obviously slowed down a lot to the annoyance of lenders, which, I understand lenders are always annoyed about something, so if it's not one thing, it's going to be another. It's very hard to keep us happy all the time. Let's talk about the secondary market. What is going on as far as making changes to increase the liquidity of the market to get things moving again since those changes?
So let me just put it in context, and it's really great to hear you describing the business the way you do, and you're obviously an involved investor, so it's great to talk to you about this from this perspective. The reason we changed the secondary market as we did on the 1st of March was, if you don't have cash on account when you buy something from the secondary market, there will be a short period, admittedly, but there is a risk that Lendy ends up holding this loan for the period between when you buy it and when you put your money in the account. Mm-hmm. So as the business, that was fine as we were growing, because we had sufficient capital in the business to sort of bridge that gap. But as we were getting bigger, we were averaging 20 million a month recently. We had 1, 2, 3 million pounds at any one time of investors that owed us money. So our liquidity, our capital, was being tied up in this secondary market arbitrage. And I don't want to blame it on the FCA, but they did say, look, you can't hold the baby, you can't hold it during the transaction, and also you can't invest in your own platform. Therefore, technically, as part of the secondary market trading, you're investing in your own platform, so you have to stop that.
Right.
So we did know it was one, we wanted to come out of that holding the baby point of view. So thank you, FCA, for making that, and it does make it more robust. It makes it more real, and it reduces the platform risk, which is a key consideration. So, we admit that it has reduced liquidity in the secondary market. We foresaw this, and we knew it was going to happen, but it had to happen. Mm-hmm. Now it has happened. There's obviously been a slowdown in the trading in the secondary market because people have to keep cash on account. There's a cash drag risk that if you've got cash on account, then there'll be a period when you're not earning anything. If something on the secondary market is not available, you've just got cash on account, not earning anything. We can't take deposits. We're not a bank. We don't want to be a bank. Mm-hmm. That's the reason we don't want to be a bank is the reason we exist. So
makes sense.
The purpose, So the purpose of removing the secondary market is less liquid because it would have been less. Let's go back. We've grown rapidly. There's lots of loan availability. Perhaps we need some more investor numbers in order to keep up with the growth that we've been undergoing. So we are targeting our market, and we're trying to improve the investor numbers generally in order to provide that secondary liquidity.
Okay, and
I think that is a fundamental point, really, because it is an art form to keep balance. in peer-to-peer, to keep that balance. We've had a huge success this year with origination, certainly since I've been here since January. And investor numbers have grown. We've been averaging 30. It's been growing very, very fast. And one of the reasons I was brought in, not only to improve communications with existing investors and improve some of the marketing as well, but it was also to reach out to new investors and to explain what P2P is. I'm doing a lot with national newspapers to educate the readers about what P2P is, and reasons we're doing Lendy Cows Week. It's a big event for us, but one of the big attractions is its target market is a perfect fit for us, and it gives us another platform, another positive platform, to educate people about what P2P is, not just what Lendy is, but what P2P is, because it is an unknown for a lot of people. So we've got a lot more to do. A lot of education to go. Lendy Cows Week, we will be entertaining, looking after a lot of kind of guests out there, and if you're here, you're very welcome to come out and enjoy the fireworks and everything with us. But it gives us 'tis another platform to help grow this business and to help build that kind of P2P kind of program for us.
Yeah, and I will say, Paul, when you were introduced as the communications person at Lendy, a lot of the people were very, very happy, because that was one of the biggest complaints about the lack of communication. Some people were frustrated about that. So you kind of flew in, you were like the holy grail of communication, which was nice. Everybody was really happy about that. Let me ask you a question about the communicative efforts. The communication has been a lot better recently, I've noticed, since you've been brought on to help with that. Is that a challenge? I mean, so you said 16,000 investors. I can only imagine people emailing you, asking questions about what's going on all the time. You just got all this communication going on. How do you handle something like that? Is something you're handling on your own, or do you have help with that?
We have a small team, and so I do have support. I mean, I think it is the challenge. Probably one of my biggest mistakes was putting my name and personal email onto one of the forums. But in many ways I'm pleased I did that, because I think we are a human business. We're run by humans. We make mistakes sometimes, and I'm very happy to put my hands up on behalf of the company and admit when we made mistakes, because I think only then can you improve what you do. And it's a new sector. It's a company that's still only really 4.5 years old, so it's learning all the time. And even though customers of any company can be frustrating from time to time, whether you're a retailer or an online sort of investment company, investment platform, you learn so much from your customers, and we learn an awful lot from our customers who are on the forum. I learn a lot through all the emails and messages, and I get through WhatsApp, email, to my LinkedIn account, everywhere. So managing where some of the communications come from can be a challenge, and occasionally I do miss things, but it is important for the company. Communications, customer service, etc., are fundamental to our kind of DNA. And
can I just jump in there and just explain a little bit of history about why we maybe left communications and customer service unattended for a while? Because obviously, as it started out, this business as an entrepreneurial business with Tim and I on our own doing this. Without any support, we were able to offer massive, fantastic rates of return back to investors, because the overheads that we had were very minimal, and we wanted to maintain that as long as possible in order to pass back and as much return to the investors as we possibly could. And we said to them very, very early on, look, we'll have an email support policy, because if we have to receive 16,000 phone calls a day, then we won't get any work done, and we'll have to employ people to do that, and therefore the returns will get hit. So we're operating very, very lean. And unfortunately, to build the business, customer service and communications came at an unfortunate and regrettable second place to building the business and getting it going. But obviously now we've got sufficient resources and customers and track record, and we've evolved from the 2-man laptops and 2 dogs to 25 men, 25 people, office building in Southsea, 17,000 investors, Lendy Cows Week. We've realised we're on the cusp of something great, and we've moved and transitioned. We're in the period of transition from the entrepreneurial to the corporate. So Paul, thank goodness he's come on board to take this off from us and to lead it and to actually give something back to the investors who have helped us get this far. So, pat on the back, Paul. Yep. Welcome on board. You can take the flak and get off the street. but
I think that's a good point, because everyone's expectations always go upwards.
Yeah.
And you can improve these things, and then once people are used to them, they forget that they weren't there before. They expect the next thing, and it's trying to stay ahead, trying to make sure that our IT, our operations, our service matches expectations, and that's the biggest challenge, because unless you employ 100 people to do it, which we're not going to do, we're going to grow in a sustainable way, to make sure that the margin that we pass back to investors is protected. and enhanced, actually, as we've been doing with the announcements over the last couple of days. But meeting or exceeding your customers' expectations is always really, really, really hard. But for every sort of challenging comment that we get from a company perspective, there are very positive, some very strong positive ones that we get in as well. We get a lot of thank yous. We get a lot of well dones, which we don't take for granted, and we do appreciate it when people take the time to say well done for doing something. Thanks for listening.
It is nice when people say well done. We don't get it very often, but when they do, it's very, very well received. So if you fancy saying thank you, a nice Trustpilot review, then we'd be very grateful.
Yeah, if anybody's listening out there, say thank you from time to time, because it's a thankless business sometimes that these gentlemen are doing, trying to give you good returns. One thing I'll tell you, Paul, if you're a Snapchat user, turn off your map, because people will be able to find you now, exactly your little location.
We've had a letter from my daughter's school about that, and so it's been going the rounds. Quite an issue, isn't it?
Yeah, you might have a few stalkers on there if you use it. But going back a little bit to the secondary market, what are the things that you are doing to try to increase the liquidity? Now, I will say this, first of all, with your company, you are very unique. The fact that you allowed people to credit their accounts without having money was very unique. Nobody else was doing that. I thought it was pretty amazing that you were able to do that. So I completely understand why you would have to stop doing the secondary market the way it was. And I'm sure it was a complete pain in the rear end. And two, secondary markets, people don't understand that they're never guaranteed as a way to be able to exit. They're always just a little additional tool that you use with peer-to-peer platforms. And I always tell people, look, if you're not willing to hold a loan until term, you probably shouldn't be buying it, because there's never a guarantee that the secondary market will be there to be used and be able to allow exit. But what are you doing as far as, some things maybe you can share about reducing the time that it's taken to sell loans, maybe increase that liquidity a little bit?
I guess it comes back to supply and demand again. We've tried to, obviously we want to grow the business. We want to be the largest and most successful P2P business out there. And our growth to date has supported that, and the investor numbers have supported that. But then there comes a point where there are so many new loans coming onto the platform that they're generally going to be more attractive than older loans coming to the end of the term. So we recognized that the risk-reward ratio was imbalanced. They're effectively buying fixed income products. No, they're effectively buying equity risk products, but with a fixed income return. Mm-hmm. So with some of the updates and changes that we've made recently are in order to attempt to address that in a small degree. So we need to increase the return on loans in the secondary market that have gone over date. Hence why we are now offering the bonus rate, which accrues at 50% of the income per month, and whoever's holding that loan at the end, when it pays back, gets the return. Mm-hmm. So we actually released this yesterday, and we also had it was a very busy day yesterday. The IT team hate me, and so does Paul. But yesterday, a default loan paid back. For example, it was a pub in Kent, and it was 200 and odd days overdue. So it had gone into default, which is our 180 day. So interest had been accruing, and yesterday we added a 3.5% bonus to that, and that will be paid today. So the day we released this policy, we paid back a default loan, and the day after, it might not be today because IT team are struggling with all these changes, mm-hmm. but very, very soon we will be honouring that 3.5% default bonus effectively to support and reward those investors that have held the loan to term, regardless of when the end of term date official was. We've managed to return nearly £100 million of the 300 and odd million to investors so far. There's no reason to suspect that we're not very good at this. We are very, very good at recovering the loans. Mm-hmm. So what we're trying to do is, back to the point, we're trying to rebalance risk and reward. We understand that in the secondary market, after day zero, it's a riskier proposition. Therefore, we're trying to reward those investors with a bit more return. So that should encourage people to hold to term or to increase liquidity in the secondary market. So people will people should buy further down because the return is higher. And as proved yesterday, we're able to return the funds to them. What else are we doing? Development loans. Development loans are, obviously, we do a bridge on day one for the land loan. Effectively, that's the 18-month long-term loan. And then the £1 million development funds, the £10 million development funds, are drawn down in a tranche basis as and when the developer puts them to work. And then the QS, the quantity surveyor, comes with us a report and says, yeah, he spent £1 million on this, this, and this, and evidence is being properly utilised and put to work. So then we go back to the investors and say, look, this guy spent £1 million on this project, therefore we need another £1 million for him to go and do it again and again and again. As the loan gets closer to day zero, again, the risk-reward balance comes into play, where we decided that we probably need to offer a degree of cash back to encourage those investors to continue to fund the development to term to get it built, because it's the riskiest part halfway through build. So let's pay them more to encourage them to get it done. So that's something that will be happening this week. And one of the issues, so that's what we've been doing over the last few days, and that's our sort of idea to increase liquidity in the secondary market by rebalancing that risk reward.
I mean, we've got some other ideas as well, which we will be kind of looking at over the next sort of few weeks as well, which we will be communicating. I can't really add anything more at the moment, just because we need to kind of get the details right, but there will be some other ideas as well. These are all pilots, Lawrence. They're all ideas that we believe will work if people kind of go for them, and if they don't have the overall effect that we want, then we will introduce some sort of new ideas as well. But we're very proactive. We're keen to hear from our investors as well about what they think will work and what they think works for other platforms, etc. So we're in listening mode, but we're also keen to kind of implement things very, very quickly as well to to get that balance between supply and demand more in line.
Okay. Yeah, and I think it's one of the issues with having this high level of secondary market is lenders tend to think that when you have such a huge amount of secondary market availability that there's a problem within the company, which is usually not the case, but it appears that way from the outside. Then the rumors start happening, well, maybe investors are selling out because they're exiting. I'm sure it's a constant problem of perception too, and it's nice to have that right balance of availability on the secondary market, but it's very also difficult to achieve, I would imagine.
Well, to spin that on its head a little bit, if there was 6 million on the secondary market on a loan book of 18 million, that's only 3% of the loan book is for sale at any one time.
Yep.
So actually 97% of our investors are quite happy to hold, and there's absolutely no problem there.
Yep.
It's just 6 million for sale looks like a big issue.
Right.
But actually, if you look at it in the whole, it's not an issue at all.
That's going to do it for part one. Tune in next time. We're going to bring you part two. We'll continue the discussion with Lendy.
You've been listening to the Financial Thing Peer-to-Peer Lending Essentials podcast. Don't forget to visit financialthing.com for all the latest peer-to-peer lending reviews and DIY investing articles.